Hello and welcome. Today we're going to work on 5 different little problems. They're kind of similar to brief exercises, so I've kind of shown how this works. So the first one has to do with how a lease should be classified. And here's what I've done. I've set up a little chart where we can figure out, is this operating or is this a finance lease? So let's see what we can do on this first one. Scortino leases equipment from Allen. The lease terms for 5 years, requires annual rental payments of $42,000 at the beginning of each year. At the beginning of the lease, the equipment has a fair value of $200,000, an estimated useful life of 8 years. The guaranteed residual value at the end of the lease is $20,000. The lease rate of return is 8%. The lease does not transfer title or contain a bargain purchase option. It's not specialized assets. So how do we classify this? Well, the whole thing with this problem is just trying to figure out, is it operating or financing? All these are false except, and so this is 5 years divided by 8, only 62% of the economic life, does not meet the 75% test. The 90% is going to be met, and we'll show how this works in just a second. So it looks like this is true. So therefore, I've got a little if statement that calculates. If any of these are true, then it's going to say, hey, it's a finance lease. So the answer to, I think this is similar to brief exercise 1. I just changed numbers. And so therefore, it's a finance lease, and here's why. It meets the 90% test. All right, so let's calculate this. We have 1 period per year. The payments happen at the beginning of the year. 5 years, 8%, $42,000 is the payment. Future value is $20,000. Here's where the book breaks down because they can only use interest tables, and this is kind of a complex little problem. You have to do the present value of the future value, the present value of the payments. It's 2 calculations. You got to add them together. Well, that's why they invented spreadsheets. That's why you do that with spreadsheets. So here's the formula. We're going to do present value. The rate is 8%. The number of periods is 5. The payment is $42,000, and the future value is $20,000. And this is going to be payments at the beginning of the period. So 1, that's our signal. So it's $194,721. We're going to make it negative because we want to show it as a positive number. So if we take the 194 divided by the 200,000, that's the fair value. Hey, you're paying 97.36. The present value is 97%. So that is 90% over 90%. So this is a finance lease because it meets the 90% rule. All right, example 2 is very similar to example brief exercise 21.2. So let's look at this and see what we know. We lease equipment for 5 years. The annual rental payments is $20,000, so I put $20,000 down here. There's a renewal option to allow Hall to keep the equipment for 1 extra year at the end of the 5th year for $15,000. Hall is reasonably certain it will exercise the 6-year option. So this makes it a 6-year lease rather than a 5-year lease. At the beginning of the lease, the equipment has a fair value of $105,000, estimated useful life of 7 years. Simmons set the lease to earn a rate of return of 5%, and this is known to Hall. The lease does not transfer title, contain a bargain purchase option. It's not specialized, so how do we do it? So transfer option false, bargain purchase false. This is 6 out of 7 years, so that's 85%. So we're going to select true, and then we're going to have the 90% test. So let's plug in what we know. It's the same formula as before. I just copied it down when I was building the spreadsheet. So if you put in 10,000, right, everything gets updated. So this is one reason why spreadsheets are so valuable, because you can change the numbers and do some what if you need to. The payments are $20,000. Also, it looks like there's going to be an additional payment of $15,000 at the end. So this is $102,672. So if I take the 102 divided by the 105, then it's 97%. So it meets 2 of the 5 definitions. Okay. Next one is very similar to brief exercise 6. All these are little homework problems. I'm just trying to give you good examples. Make sure you know what's going on. All right, so this one we have to do some lessee entries. So let's say Clancy Company leased equipment from Red October Inc. on December 31st, 2019. It's for 5 years, equal rent payments of $40,000 at the beginning of the year, starting December 31st. The equipment has a fair value of $175,000. At the beginning of the lease is the fair value. It has a useful life of 5 years, no estimated residual value. The appropriate interest rate is 8%. And let's assume straight line depreciation for similar assets. All right, does it transfer ownership? We don't think it does. Does it say anything about that? No. We do know, in fact, does it say? No. So we have, it's 5 years divided by 5 years, right? So it's 100% of the economic life, so that makes it finance lease. Or we can do the 90% rule. So all we do is $40,000. There's no payment at the end. There's no future value. It's going to be 8%, 5 years, so $172,000. So $172,000 divided by $175,000. This makes it a finance lease. So what entry do we need to make at the end of the year? This is right of use asset for $172,485, and the lease liability is $172,485. The present value is the cost of this asset. Now, if it were a purchase, if we call this financing, this was a loan, we would just say equipment, credit, notes payable, right? But this is technically a lease that looks a lot like a loan, so we debit the right of use asset. And then we also have lease liability debit, because we get the cash the very first day we recognize the lease liability, we get our first cash payment. We make our first cash payment of $40,000. So we have the lease liability and then $40,000 reduced cash. What do we do at the end of the next year? Well, we need to figure out the interest expense. Now, this number is, it's going to be the 172 minus the 40. We only owe $132,000, and it's going to be 8% interest. So this is $10,599. The cash payment is $40,000. So the $29,000 is just the difference between the 40 and the $10,599. So that's our lease liability. The next one, what do we do about the amortization expense? We're going to take the right of use assets, which is $172,000 divided by 5. So that's $34,497 is how much our straight line depreciation is. Because this is a leased asset, we have to call it amortization expense. And we don't have an accumulated depreciation account because it's amortization. We don't have an accumulated amortization account, so we just credit the right to use asset. Technically, we don't own the asset, but really this is substance over form. The form is legally it's not our asset, but economically we've purchased this asset. So it's the right to use asset. So that's the entry we need to make. All right, number 4, very similar. Brad Thor has recorded a right of use asset for $450,000 from a finance lease on December 31st, 2019. The incremental borrowing rate is 8%. The implicit rate of the lessor was not known. Thor made the first lease payment of $72,506 on December 31st, 2019. The lease required 8 annual payments. The equipment has a useful life of 8 years with no residual value. So this is an 8-year lease. So 8 divided by 8, 100%. Now, if we did the math, then you end up with $449,999. That confuses people sometimes. $450 is the same thing. So we could go back and change this to $449,999, or we're just comfortable with a $1 difference. We could make this for $450,000. No worries. We'd have to come to some pennies or change the rate slightly. So I'm just sticking to my interest. So it's $449,999 if you prefer. And then we debit right of use asset and credit lease liability. Debit lease liability and credit cash for $72,506. That's the payment. The interest expense is going to be the $449 minus the $72 times the 8%. And then we know our cash payment is $72,506. So the difference is the lease liability. You can see, one reason I build a spreadsheet, you can see my work. I'm showing my work within the cell. And then you have to amortize this. So you take the $449,000, or it could be even easier. It's this original $449,000 divided by, is it 8? Yes, $56,250, and there we have that number. Now we're off just by $1, not a big deal. We're talking about $450,000. $1 is not a big deal. All right, one more. This is similar to exercise 10. This is the lessor entry. So deep work, leased equipment that had a cost of $180,000 to Cal Newport Corp. The lease of the term is 6 years with equal annual payments of $65,000 beginning December 31st, 2019. It has a useful life of 6 years with no salvage value. Implicit interest rate is 8%. No bargain purchase option. No transfer of title. Collectability of lease payments for deep work is probable. So prepare Newport's December 31st, 2019 journal entries at the beginning of the lease. All right, so this is a 6-year lease out of a 6-year asset. Now, we think this is really a sales type lease, right? Because it looks like Cal Newport has equipment that it's just selling to deep work, except they're calling it a lease. So this is a sales type. It's going to include cost of goods sold and things like that. So we think that they're going to sell it at what they think it's worth, right? So by definition, the selling price is the fair value. So we're going to say that's true also. This is a finance type lease, which is a sales type lease for the lessor. Let's plug in what we know. 1 period per year, beginning payments. The number of periods is 6, 8%, 65,000. We end up with 324,000 is the present value. So we're going to set up basically a lease receivable for 324,000, and we recognize revenue. Now remember, this is just like accounts receivable and sales, right? Accounts receivable and sales. Then we need to set up cost of goods sold and inventory. Now the book in exercise 10 does this as one entry. I typically don't do this as one entry, so I'll say cost of goods sold and inventory is 180. That's our cost. So we're making it for Cal Newport, which is the lessor in this case. Well, what do we do about the first payment? We debit cash and credit lease receivable for $65,000. All right, so that's how you do the basic problems in chapter 21, the leases. Leases look a lot like another way to finance a purchase. It's not really technically a purchase, but it's a lease, so we account for it in a very, very similar way. All right, thanks for watching. Good luck.